Hello and welcome back once again to Southbank Live, the live stream we host on YouTube and LinkedIn and indeed elsewhere in order to take a look behind the big trends, the big investment news of the week and try to figure out a little more about what's going on in the world. Now, this week we were going to have Nikolai Hubble on. However, he's sadly very ill all of a sudden. He has tested negative for Wu flu, if anybody is interested, but he should be all right, should be coming on in a future episode. In the meantime, we have got Charlie Morris, our great editor over at the Fleet Street Letter Wealth Builder, and of course, a former billion-dollar fund manager. Now, Charlie is now the founder of ByteTree, a blockchain analytics firm, has lots of interest in the crypto space. There's lots of things we'd like to discuss with you here today, Charlie. But just to start off with, the bear in the room as it is, the Ukraine-Russia conflict. What's your thoughts on that? Because you've invested through numerous crises over the past decade, few decades, and of course you have military experience from your time in the Grenadier Guards. I'd love to know what your take is on the overall situation.
It's very, very sad, isn't it? And it does seem that Putin is running out of friends. But I think economically, it's interesting to know that the ruble's been appreciating the last few days quite aggressively. The Russian stock market reopened to some degree today. You can't trade in, most Russian stocks had a lot of liquidity in London, but that's not open, obviously. Right. We've now seen a big price differential between what a Russian share's worth in Moscow and what it's worth in London. And you could drive a bus through the gap. Yeah. So it's going to be interesting. If he is overthrown, then I think it's going to be one hell of an opportunity from an economic perspective. But if he's not, we're going to drive the world into two groups. Bit different from the old Cold War. I think my analogy is, you know how the airlines got together a few years ago and created One World, which was the good airlines, sort of American Airlines, British Airways, Cathay Pacific, Iberia, etc., and Qantas, and that gang. And then there was, the Star Alliance, which was the ones that couldn't quite get into the A team. And Air France and stuff like that, and so I think the world is going One World, Star Alliance, and the naughty boys are in Star Alliance. But it does seem that their workaround sanctions is quite powerful, which brings me to today's news that Boris is asking for to attack the Russian gold reserve, saying, well, what can we do about that? So there's it's really heating up. Economic warfare has become a thing.
Certainly. In this analogy of One World and the Star Alliance, that the Star Alliance will be investable in the future if things just continue to get worse.
I think it's going to be difficult. I think there's going to be moral questions. And obviously there's the opportunity. I mean, who doesn't want to take advantage of, any good capitalist would want to take advantage of good opportunities. I mean, China's a proud, great nation, and there are lots and lots of fantastic businesses there. And, Russia's full of natural resources, and who wouldn't want a piece of that? But there will be moral questions, and so the ESG will probably get a new letter on the end. And I think it will be one of those restrictions. Stick to One World, please.
Yeah, and I can imagine lots of angry folks at universities campaigning to make sure that the university's annuation scheme is not investing outside of One World, etc. But looking at the Russia-Ukraine situation as it is, you mentioned if Putin is overthrown. Now, of course, we don't have a huge amount of as to exactly what's going on, or certainly not public information. But are you seeing that as a definite possibility, and one which, how likely do you think that might be?
Well, I'm hopeful. I think this is the strategy, because the more firms that leave the Star Alliance, the Russian Star Alliance, and so you walk around Moscow today, most of the retailers, I gather they're in shopping malls rather than just sort of down the high street, because that's how they do things. But all the sort of fancy shops are pretty much shut down. And so, it really bites for the people. Not only is they lost money because their currency's gone down, their inability to communicate with the world, their internet's restricted. And the hope is that, you still want a revolution. And as far as I can work out, quite a lot of Russians are good guys. And one doesn't know how much of it's propaganda, how much of it's real. But I suspect that quite a lot of people are good guys, because it's a pretty logical place to be for someone with a bit of human decency. And I think, if he is overthrown, poor old Russia is still, going to have a new leader and hopefully be a better place to live in the future. But they're still going to have to spend all those reserves rebuilding Ukraine. So there's going to be a real mess, whatever happens after this war ends. And I hope it ends soon, whatever the outcome is.
Yeah, I think it's in everybody's best interest that we do see an end to the conflict. Or, I mean, certainly hope it's in everybody's best interest that this isn't dragged on into another Afghanistan or another Vietnam. Charlie, just in your microphone, you do sound slightly distorted. Is there anything that you can do on your side to make it sound a little bit clearer?
I shall plug in a pair of headphones. So keep going and I'll do this.
All right. Yeah. So we start with the Ukraine-Russia conflict. It's obviously creating a lot of pressure in commodities, as Russia is, of course, very big in the commodity space of pretty much everything that we really need, be it grains, be it energy, oil, gas, or certain metals as well. It's very interesting to see what's going on in the palladium market at the minute, because Russia has such a dominating role in the palladium market. But just generally on inflation as it is, what is your take on the really high oil prices and the really high CPI that we're getting at the minute? Do you think this is going to be sustained for a long period of time? And if so, where should we be allocating capital to hedge ourselves from it?
Well, it's a really good question. It's the most important question in finance, is whether inflation is going to pass, if there's peace or something like that, or whether it's here to stay. And I think that we're going to have a high average rate of inflation for several years to come. But inflation is notoriously choppy. So my analogy is the children's game of whack-a-mole. So it pops up somewhere, and then you solve that problem. Like after COVID, we had lots of bottlenecks, and it all started with lavatory paper, if you remember. And there's these shortages have just sort of gone on to other areas, and the latest place has been commodities. And we're going to have problems in the food, because food is basically closely linked to oil, whether you're talking about tractor diesel or whether you're talking about fertilizer. And so all of these things is going to keep going for a long period of time. Now, what does the market think? Well, we're starting to see the longer term indicators of inflation come through. And this has been the thing that the Federal Reserve in particular has said, it's transitory, because short-term inflation expectations, as told by the price of TIPS, inflation-linked bonds, indicate lots of inflation in the short term, but not in the long term. But now the long term is beginning to disagree and say, actually, it's going to be higher. This is why the central banks are now panicking to increase interest rates. And by the way, this inflation is coming through in Japan as well. I mean, people are not saying it because they're not seeing it in the historic numbers, but the forward-looking numbers are saying inflation is everywhere.
Very interesting to see it take place in Japan, where, of course, deflation has been the key issue for so long. When you're thinking of how this might disrupt markets, there is so much debt in the world now, and the higher inflation goes, that becomes a very, very choppy ride for people who are in the debt market. How much disruption do you think inflation is going to sow in these credit markets, which have been so still for so long?
There's a lot of debt in the world, and the problem with higher interest rates is that if you issue new debt, then you'll have to lock it in the new higher rates. So it becomes very, very expensive to the government to run deficits. Now, ironically, the price of the bonds you issued before as interest rates collapse. So if you look at the Russian bond, sorry, I beg your pardon, the Austrian bond, the 100-year bond, that's already down by about 50%. And so, ironically, the government could, if they were wise, buy that bond back at half the price they issued it. But of course, they haven't got the money. I mean, this is the thing. And if they to issue new bonds to do that, they'd actually pay more money to borrow in the short term in order to buy back those bonds. So it's a difficult situation, and I feel sorry for the Chancellor of the Exchequer. I'm probably the only person in the country who does, because I think he knows that there's a funding crisis coming. And so everyone says, you got all this money from inflation, from higher VAT receipts, and give this away, give that away. And he's doing the right thing by not taxing the North Sea oil, because otherwise, why would you invest in North Sea oil if you're just going to give away all your profits? Why would you take the risk? And so he's done the right thing there. And I think he's just trying hard not to blow all the money. I mean, I think that he recognizes that we've got a record high debt to GDP ratio in peacetime, or peacetime here. and it's going to be really, really tough. You know, we live in a world of expectation. People want the government to do everything, and you know, healthcare is a spiraling cost. And you know, I'm not talking about the moral side of it. Of course, everyone deserves everything, but you know, we can't afford it. As simple as that. So you know, reality is going to have to kick in, and it's going to be a very, very painful transition for markets to comprehend, because ultimately, consumer will be much worse off. I always think that, you know, what does a higher oil price mean? It means fewer trips to Pizza Express. That's what it means.
Yeah. Speaking of North Sea oil, we do have someone in the chat who is currently in Aberdeen. Hello, John S. It's great to have you here. And indeed, hello to Barry and Andrew, who have tuned in on YouTube on the live stream at the minute. We get a question from John T, who says, after 2 world wars, debt seemed to take decades to address. Governments now print money and inflate debt away continually. Is printing money here to stay now that they know how to do it? My response to this would probably be they've known how to do it for a very long time. It's just only now that they've really found a decent enough excuse to get away with it. But Charlie, do you think government coordinated inflation in this manner, which we have it, where we have so much easing still in the financial system, while the government is still spending money willy-nilly, and if people like Rishi Sunak to rein it back somewhat, like it's going to take a very long time before we get to anything like balanced budget again, or a return to the 1980s, where we have high interest rates and this government spending with bond vigilantes forcing the government to spend less. Do you think this sort of period that we're in at the minute, something that, you know, in 10 years it'll be way different and we'll have gone back to some kind of normal, or are we going into a period where there's lots and lots of government intervention and we're kind of in this for the long haul?
Yeah, I mean, there's about 15 questions you just asked me, and I'll have to unpack them a bit. But I think that let's talk about the start of that, which was, will they carry on printing money? Now they know how to do it. Well, you're right, they've always known how to do it. But the markets historically haven't let governments do that in a big way for long periods of time. What's changed in the last decade was, after the financial crisis, we had this extraordinarily low inflation. And people like me were slightly puzzled why it was so low for so long. But it just took the trigger, didn't it? And I think that we have a couple of things. You know, we had the huge injection from COVID, which is probably, well, it was a step too far. And now we've got the disruption to the supply chain and this wedge between the world. And so you can't do that. If the bond yield is rising, you can't just go out there and take advantage of free money, because money's not free anymore. You know, it's actually going to have a real cost to it. Now, we're not at the crisis point yet, but you can see it coming. And so, if I was the Chancellor of the Exchequer, I'd be fighting to balance the books, because if you don't take the initiative, the markets will do it for you. And don't forget, countries like Argentina and stuff, they haven't got this luxury of printing money and giving it to everyone, because their currency collapses by 30% a year anyway. And so we still have stable currencies somewhat, but the latest currency to go down is the Japanese yen. That's been happening in the last few days, and that's basically because their inflation is telling it it's going to be just like British, European, American inflation, and they've committed, the Japanese government committed to low interest rates, to easy monetary policy. Do that, then the currency falls. I mean, this is really important. This is the outlet of all this, is currency, and currencies have been ridiculously stable for the last decade. Why have they been so stable? In most cases, Turkey and Russia aside, and that's because there's two things about zero interest rates which are interesting. One is that they're zero, which is a very low number, but the other thing is that they're all the same. And so if everyone's on zero, then everyone's got the same interest rate. Historically, you would assume that a currency would move with rate differentials between countries, specifically real interest rate differentials between countries. And so now that the rates are coming off zero, we're going to start to see differences between countries. So we're going to start to see big moves in foreign exchange. And I think that's going to be a massive theme for the next decade. We're very used to stable FX. That's over now. It's gold instead.
Right, which brings us, of course, to the original or the as some people would describe. I mean, Charlie, when you're thinking like go first, where these interest rate differentials may arise, and you had to bet on a good currency to stay with outside of gold, if we were staying in the fiat world, where do you think is going to come out of this better relative to everyone else? So even if all the currencies are falling together, they're just falling at different speeds. Which one do you think would be the safest that you could tether yourself to?
Well, it's whoever's hiking interest rates the most aggressively is the safe haven. Yeah. So we know Japan, the yen's already falling because they're saying they're not going to hike interest rates at the same speed as everyone else. I would think the same is the Eurozone. I think the Eurozone will be behind the curve compared to America. I think Britain's somewhat neutral. I don't think we're a good place to be. I don't think we're a bad place to be. I think we're in the middle. I hope that we hike aggressively because I think you've got to protect the money. If you don't protect the money, then actually the consequences down the line are even worse. The politicians would always say, well, keep the rates low, ease the exchange rate, we'll export more, stimulate growth that way. But it doesn't work. If that was true, then poor countries would be rich and rich countries would be poor. It's not a coincidence that Switzerland's rich, where you've had over the years harder monetary policy than you've had in many of its neighbours, which have, for example, the southern European countries pre-Euro always had much higher inflation than places like Switzerland, and it showed through in the foreign exchange.
Right. Looking at that that dynamic, because of course, the Swiss central bank has taken to buying American stocks to back its currency. It's no longer backed by gold. You wonder if any of these traditional relationships that we've seen between with safe havens and then the much more exotic ones might change. Have you? Is that something you you'd be open to, or do you think still historically Swiss franc's going to be a safe haven, and the Brazilian real is going to be really really risky one, or do you think the commodity price surges that we're seeing might change those traditional relationships?
Yeah, we're going to see lots of change because it's all about capital flows. We've already seen the Brazilian real do quite well. They're on the right side of all this. And, the Russian ruble's appreciated in the last couple of weeks because the sanctions got it down. But actually, reality of commodity prices is getting it back. And if the sanctions were imposed by everyone, then the ruble would be pretty much worthless. But they're not. There are plenty of countries that are saying, well, thank you very much, Russia. We'll carry on dealing with you, notably China and India and others, no doubt. So, right. But the difference between the interest rates in Brazil and the West will close. And Brazil's going to enjoy some huge capital inflows. So absolutely, that's going to be one of the big changes. What we describe as developed and the sort of the complacency we have around this idea of what a good country and a good currency and a good stock market looks like is all going to change. In America, for example, there are plenty of cheap things to buy in America. There's plenty of good companies you can buy which are not heroically priced, but the average member of the S&P 500 has never been more expensive in history. Certainly if you go back a couple of months, it's softened a bit, but go back to November time. Not just the tech stocks, but things like McDonald's and Disney, all of these things are just massively rated because there's assumption in the market that inflationary rates are going to stay low forever, and if so, then the price of shares can be very, very high. So just as bonds and shares are linked, if the price of bonds is going to fall because rates of inflation are going to rise, then the price of shares ultimately will follow. It will just take a bit longer.
Which brings us to what is the great safe haven for investors in inflationary times. Now, if we go back to the 1970s, this was a great decade for gold. That was the asset to own during the 70s. And Charlie, you've said that while the asset to own in the 70s, Bitcoin is in the 2020s. Could you expand a little on that for us? And let's explore a little more about the relationship between Bitcoin and gold together.
Yeah, and I'd love to have bought Bitcoin in the 1970s with new Boaz.
Me too. I regret it every day, Charlie.
And the 1940s as well. I think one questioner made the comparison about 70s or 40s. We could probably do it either time. Some people have made the point that there's a 40s comparison because it's sort of post-war high debt situation. But whatever. Let's just stick to the inflationary thesis. I mean, gold did a lot in the 1970s, partly because it had been fixed at a very low price. And so, the first kind of 5 times, or I think it was up 27 times over the 70s. I think the first sort of 3 to 5 times was the revaluation to get back to the price it should have been, because the price had been suppressed. But then the rest of it was a very real, justified appreciation. And then it got a bit out of hand towards the end, as these things do. But basically, a portfolio with 8% gold, I think, allocated through the 70s, maintained its value. So if you had a traditional portfolio of bonds and equities and something like 8% gold, then you won, as in at the end of it, you didn't lose money in real terms. I'm not saying you made money, I'm saying you didn't lose. But if you didn't own that gold, you're in real trouble. And so, I think it's really important to own gold, and I've been a fan of it for years. And, it's still the best performing major asset this century. And people forget that gold is ahead of all major stock markets since the year 2000. It's taken a bit of a break since 2011, but, got going again in 2018. And, I have a fair value model based on rates and stuff, rates and inflation for gold, and it's trading at fair value. Gold is not overpriced in a world where many assets are overpriced. And it's great because the central banks want to own it. They own $13 trillion worth of the stuff. I beg your pardon, that's the entire gold market. They own $2.5 trillion worth of gold. And that number is going to go up. They're just going to keep buying. We're seeing investors having exited the gold market since the summer of 2020. We've seen them come back in the last 3 months. Why wouldn't you have some gold in your portfolio? There's just no reason not to. The worst that could possibly happen is that your portfolio does really well and your gold doesn't do very much. So what? It's an insurance policy for an extreme event, and I think that extreme event's looking quite likely.
When you're thinking of the kind of tailwinds that could assist gold at the minute, the sanctions on Russia's foreign exchange reserves is something that I would point to, and plenty of other commentators have pointed to as evidence that central banks globally are going to need more gold, because they've seen that if you disagree with America, it's now completely open season on your foreign exchange reserves. They can just be effectively stolen, and you won't, even if you earned them completely legally. Is that something you'd agree with, or do you think for gold they should be looking at different sources of new gold demand?
It's a really interesting question, because I think there's an article in the Times today how Boris has been asking the sanctions guys, the sort of the club of nations, the one world nations, to sanction Russia's gold, which I don't think means steal it. I think it means just sort of freeze it or something. I'm not quite sure what the details are yet. But what does that mean? Well, if you are Russia and you have your gold in Russia, that's great, but you can't do much with it. So if you can't sell it in the international gold market in London. So most central banks historically kept their gold in London because that's where the gold market was. So if you wanted to trade, you could settle the trade in London. Now, it's dangerous, isn't it? Because it started with Venezuela, this whole idea of confiscating gold. So it kind of loses its purpose if you know that you're going to have to face the One World Do Good Committee if you're a naughty dictator. So that does probably take some appeal off owning gold in that sense. But then you say, okay, we'll just take it home. And that's fine. You can do that, but then you can't trade it. But you could go through the Shanghai exchange, assuming that was a friendly country. And then they could still trade with London whilst they don't remain an outcast. So you can see how the geopolitical dominoes will fall on this one. And I don't think it's going to be very impactful for the gold, because I think there are plenty of buyers if a country wants to sell. That wouldn't have been true 20 years ago, but it is true today. So gold is, massively relevant, but there are some really interesting questions arising about this new economic warfare. It's all well and good having lots of missiles and carriers and planes, but actually these economic warfare tools are pretty powerful beasts, aren't they?
Certainly. Where do you think Bitcoin fall that?
Bitcoin's the up and coming one, and I suppose in this sense it's probably better. If you were to choose between gold and Bitcoin in the confiscation sense, it's actually got you can't confiscate Putin's Bitcoin. I don't know if he's got any or not, but you can't, because it's the phrase in his head. And so in that sense, it's pretty interesting. But central banks, outside of places like El Salvador, really haven't got involved. The Bitcoin market is, just over $500 billion. The gold market is 13 trillion. So they're poles apart in types of size. If central banks started trying to buy Bitcoin, I mean, the price would absolutely rocket. I think 5-10x in a heartbeat if a major central bank got behind it. And the other thing, hilariously, just as the Gordon Brown when he was Chancellor told the world how he was about to sell gold in 1999, I think it was, and so the price fell ahead of his sale. You can imagine the central banks in the Western world announcing they're about to buy Bitcoin before they actually bought it. So, which would be a really stupid thing to do as a trader, but it's the sort of thing they'd have to do from a transparency point of view. So that would just be Christmas for the Bitcoin market if these guys got involved. I don't see it happening anytime soon, but it's not impossible one day.
Yeah. For that day, how do you think Bitcoin responds in this inflationary environment?
Yeah, well, my thesis on this is very simple. It's called BOLD. Bitcoin and gold is BOLD. And the thesis behind BOLD is that just as you have in a low inflationary environment, you own bonds and equities. And in the bad times, when there's a recession, the bonds go up. And when the economy is doing well, the equities go up, in a nutshell, very simple terms. In an inflationary environment, bonds and equities aren't your friend. I mean, some equities are, like oil stocks and stuff. But, basically most of the stock market is not your friend. But in an inflationary environment, gold and Bitcoin are your friend. And gold does very well when the tide's going out, when the world's terrible, and when there's a recession and all that. And when the economy is expanding during the inflationary periods, which still happens from time to time, it's cyclical, then Bitcoin would do very well. So I think it's fascinating that a blend of gold and Bitcoin, which I would recommend about 80% gold, about 20% Bitcoin, something like that. You don't need much Bitcoin to make this work. Is a very powerful inflation hedge. And also, it reminds you that you don't have to trade either asset, because if your gold's going down, your Bitcoin's going up. Great, thank you. And if your Bitcoin's going down, don't worry about it. Your gold's going up. And they only both go down when the inflation ends, at which point the rest of your portfolio kicks in.
Do you think that relationship, though, Charlie, where Bitcoin trades in line with the equity market, it might change?
No, not really. I think it's a risk-on asset, and so there's a difference between correlation and performance. Correlation is, if the S&P 500 or the Nasdaq or the FTSE is up 2%, then 99 times out of 100, Bitcoin will be up that day. And if the FTSE, S&P, Nasdaq are down 2%, 99 times out of 100, Bitcoin will be down that day. But but over time, the performance can diverge significantly, despite that short-term correlation. So you could be in a position where stock markets, go up 10% or go down 10%, but Bitcoin could have trebled or have halved.
Right. Now, Charlie, it has been great having you on the show. I know you are very short of time. You're a very busy man these days, as you've always been. Just any final closing remarks before you have to trot off to your next meeting today?
I think it's a time to be cautious. I mean, in the fixed rate wealth builder, I've barely traded this year. We reduced some risk late last year, which was possibly a lot of luck there, but certainly some good judgment too. Things were heating up. You could see that long term, there's always an element of luck in investing, and but I think we were about right. I just wanted to exit anything popular and find unpopular things with a value bias, anything that was cheap and a bit out of favor, and so that's what we did, and that's worked quite nicely. But I think what am I doing next is really not much, and doing not much is a strategy. I think these markets are going to fool you. You'll see the rallies in the S&P or something, and you'll want to say, "Oh, let's go and buy tech stocks or something." But it just don't. I mean, just be calm, own good stuff, and don't trade too much. Get your balance of your portfolio right. I think that's much more important than trying to be clever in this market.
Well, there you have it, folks. That was Charlie Morris, the editor of the Fleet Street Letter Wealth Builder. Charlie, thanks so much for joining me.
Thanks, Boaz.
Good stuff. Good stuff. I'll stay on this call for a little while with the chat, maybe taking a look at some of the questions we've got. But that'll be all from Charlie for today. And I'd actually like to share some of our long short segment as well. This is the part of the show where we take a look at some of the assets that have been doing really well over the past week, or some of the assets that have been doing very poorly. But it doesn't always have to be assets. In fact, it can be anything for our long short segment. Of course, Southbank Live is intended as a show for informational and entertainment purposes only, and not for speculation purposes. I'm afraid I can't share any alpha with you if you're trying to make money this week in the market. But yeah, this week I think it's mostly going to be my long for this week would be inflation. For all of the reasons that we've discussed, this is not something very new. It's not a very good. It's not a very good or novel long that I'm bringing to the show this week. But the one thing I would like to dwell on is my short for this week. I'm very, very short a certain asset. Well, actually, it's not a certain asset. It's a certain profession. This week, I am short economists. And this is due to a particular article that came out over the past week. And I'll show you. Let's take a look. So yeah, this one, here we are. This is from Bloomberg. Inflation stings the most if you earn less than $300,000. Here's how to deal. Very American saying. Here's how to deal. More Americans than ever expect their finances to worsen as inflation hits a 40-year high. Do you really need that extra car? So this is Bloomberg, and this is a Bloomberg opinion piece. Okay, so this is not direct from the editorial board, but these are the tweets that came along with this article. From selling your car to foregoing chemotherapy for your dog, Teresa Ghilarducci has tips on how to beat inflation. All right, so this was one of the tweets that supported it. There was another one that was even more egregious, which was inflation stings most if you earn less than $300,000. Here's how to deal. Take the bus. Don't buy in bulk. Try lentils instead of meat. And nobody says would be fun. Right, that was, so, okay. I'll outline my short thesis on economists here. From the outset, we've got this headline. We've got these tweets. To begin with, I was giving the benefit of the doubt to the fact that this was just a very clever social marketer who was wanting to get a lot of engagement on Twitter, and so deliberately put out sort of a lot of red flags regarding the article. You got the headline, and then you've got nobody said this was going to be fun, in order just to mine engagement, in order just to get people really annoyed. So they'd reply lots, and they'd retweet it with lots of angry things, and they'd get loads of clicks on this article because it was just saying something that was very outrageous. I was going to give it the benefit of the doubt. This is not tone deaf. This is very shrewd social media manipulation, as it were. And this, however, I opened the article. I read the article. And I'm afraid this was not the work of a very shrewd social media marketer. This was actually the most tone-deaf things I've read for a very long time. I'll see if I'll just open it up here. Yeah, here we are. There's one part of this article that I'd like to read out to you today. It is behind a paywall. As I said, this is Bloomberg opinion. Okay, this is not direct from Bloomberg. But here we go. Quote: if you're one of the many Americans who became a new pet owner during the pandemic, you might want to rethink those costly pet medical needs. It may sound harsh, but researchers actually don't recommend pet chemotherapy, which can cost up to $10,000 for ethical reasons. I'll read that to you again. This is an article about dealing with inflation, right? If you earn less than $300,000, right? If you're one of the little people, you're the little guy, right? Here is the advice coming to you from up high. If you're one of the many Americans who became a new pet owner during the pandemic, you might want to rethink those costly pet medical needs. So the author is being deliberately ambiguous here. They are not being overt with what they are implying here. But you might want to rethink those costly pet medical needs. So say for example, you're a guy who you lost your job during the pandemic. You were placed under house arrest by the government. You lost your source of income, your ability to maybe support your family. You're feeling very lonely because nothing like this has ever happened to you before. You can't see your friends. You can't see your family. You can't get your your kids aren't even allowed to go to school. If you've got kids, they're not feeling very good. So you buy a dog. You're feeling really lonely, and now the dog gets a bit ill, and you think, wait a minute, I've read this really clever Bloomberg article. There was that clever lady, the economist, and she told me what to do here. I just don't do anything. I don't pay for vet bills. That's how I deal with inflation. This is the advice. We just don't pay vet bills. And in fact, something that maybe the author isn't aware of because they're so out of touch, or maybe they just didn't think about it. Having an animal put down costs money too, and we've got to avoid these costly pet medical needs. So, I mean, deliberately left ambiguous because the author didn't want to say, let your dog die. But then at the same time, in being so ambiguous, it may even suggest that you're meant to do it yourself. Like you're meant to, you've got to avoid those costly pet medical bills. Having a dog put down, it's a costly pet medical bill. So maybe we're just being told to, get out the shovel. I think it's quite an extraordinary statement. There's another line I'd just like to read from the end of this article. It's only a couple paragraphs down. And this is, again, how to survive inflation. So kill your dog. That's how you survive inflation. Try to be as flexible and creative as possible. Scientists tell us our brain plasticity will improve by trying novel things, like killing your dog, maybe. There's an advantage to mixing up what you consume to cope with unusual price spikes. You become more resilient as you create a locus of control and interrogate your habits. Yeah, I can imagine you're going to become really resilient after you've killed your dog. I think you're going to be stone cold. Nothing is going to faze you. Nothing's going to faze you after that. And that, folks, is why this week I am short economists. I really don't think that was a very clever article to write. Again, Bloomberg opinion. I think we're probably going to see a lot more of this. So I think, I'm short economist. I think this is going to bring the profession into a lot of disrepute. To John in the chat, who is an oil and gas economist. Well, you're one of the good guys out of oil and gas, John. So I'm meaning more the ivory tower, the central bank PhD, that kind of thing. That's more the side of it, of the economics profession that we're shorting this week. But there you have it, folks. If this show, we were trying to look at inflation and we were trying to understand how investors should best prepare for it. But here we've got the advice from the really clever people from up top, right? You want to survive inflation? Kill your dog, and then go eat some lentils. And remember, this was never meant to be easy. This was never meant to be fun. Just extraordinary commentary there this week, and that's why I'm shorting economists. However, Apple comments, every dog has its day, including Bloomberg. That's quite correct. Quite correct. We do have suggestion to add dog to your increasingly varied diet. Sadly, in some parts of the world, they do eat dogs. Very, very grim indeed. In China, they've got a big dog meat market. Very grim, I must say. Just looking down on some of the comments in the chat. Thanks to everybody who has tuned in, and apologies for all of we've had a few mix-ups. So last week we didn't get the YouTube stream going. It was just Facebook and LinkedIn. This week we've had some issues with Facebook stream, and then of course Nikolai got really ill, so it wasn't going to be Nikolai on the show. Instead, but we did get Charlie, who was of course a great market commentator. We're just going through the chat. Anyone got a hedge for nuclear war? That's from 50-year-old novice gym man. And then we do have a few comments. I would agree. Iodine tablets. I mean, it's not a hedge, but it's as best as you're gonna get. I think actually. It's if you're a little guy. If you earn less than $300,000 a year, that's your hedge. If you're a billionaire, I think the main one is New Zealand. They did loads of wargaming for this stuff. New Zealand was one of the areas less likely to get hit by a nuclear strike, and they've got all the billionaires have their bunkers there. Peter Thiel, lots of actors. I think Matt Damon's got a hideaway there. There are many very, very rich people who have their nuclear hedge in New Zealand. I think that's a very common place that people would like to go. New Zealand, of course, very, very anti-nuclear energy, and they won't let nuclear ships or submarines dock in their ports and things like that. And yes, indeed, there will be a recording of this made available on our YouTube show, on our YouTube channel. Sorry, and for anybody who did miss the very beginning of this. Let's see, historically, Sandeep from earlier asking historically, is the current situation equivalent to 1940 or 1970? Well, I wouldn't say 1940, as that is full-on kinetic world war. So on that front, it's quite different. We're not devoting our entire countries to war production here in the UK, at least. We're not handing in our spare frying pans in order to make Spitfires, which may actually have been a complete propaganda operation. So we're not there. I'd probably say I'd lean more on the 1970s side, but there are other economic factors to be taken into account for that comparison. Yeah. Any further questions? Nikolai's long on tractors. That's from Jason. Quite possibly. I would not be at all surprised if Nikolai was very long on tractors. Of course, agriculture is going to come back to the fore during a big inflationary cycle, and people are actually going to suddenly maybe start valuing people who work in the agricultural industry rather than blowing them off as just these backward guys who live out in the countryside. I think it's not before time. I think maybe Greta Thunberg's opining on energy and agricultural industries as being very, very bad, I think may have been like peak cosmopolitan disdain for people who work in critical industries. Maybe that was the peak, and from there on, we're actually going to get folks valuing those people who work so hard in these industries, which we require for all of the nice things that we have in our lives in the developed world. All the food, all the ability to have the lights on. It comes down to hardworking people who often don't get any of the glamour associated with working in cities and banks and things like that. So hopefully, and Nikolai's long on tractors. I'd probably be long on tractors as well. I think it's the issue of getting the fuel to the tractors is going to be a tricky one. There was a few articles this week, also shortages, which is kind of ironic. Everyone's been railing against diesel over the past several years. I mean, it started with Gordon Brown saying diesel is good for the planet. Then we get the big VW diesel gate, and then everyone hates it for ages. Not even be able to get it even when we need it, which it seems to be history is not without a strong sense of irony. Robbie comments regarding the billionaire's nuclear hedge. The Chinese Communist Party, I would assume, have bought New Zealand. They will walk in to reclaim their property at some point. Then where will the ultras go? Good question. You do wonder how, a billionaire bunker well underground, you've probably got lots of nuts and canned food. But have you actually wargamed what staying inside that for several months would actually be like, and whether or not you'd be able to have the logistics to get further supplies in after that? It seems to me, like with a lot of bug out bag strategies for prepping for a big apocalypse, that this may sound really good, but you'd end up running into lots of things that you hadn't thought of ahead of time that would really scupper your attempts. I don't know. I'm not a billionaire with a bug out bunker in New Zealand, and so that's thankfully not going to be my problem. But if everyone sees New Zealand as a good place to hide out during a nuclear war, you are going to encounter people who have planned for other people to be there, who maybe have more stuff, and maybe they'd like some of that stuff. So maybe the Peter Thiel's, well, I don't know. Peter Thiel is obviously a very, very intelligent guy. I'm sure he's very heavily armed, etc. But I think I think a lot of these survival-esque strategies of, okay, as soon as I see a mushroom cloud on the horizon, I'm going to get in my private jet and we're going to fly straight to New Zealand. It's like, well, who's going to be flying you there? Are they not going to be are they not going to just steal the private jet to get their family out of Dodge? I mean, wargaming this stuff is very fun, but I do wonder what would actually happen. But we are getting off on a bit of a tangent here. Just going through the chat, if there are any further questions for us to have a little chat about, it is great to have a direct conversation. Normally we've got a guest on, but it's good to speak directly to the chat like this. Let's see. This was from John regarding Shanghai Gold Exchange. Isn't Shanghai in too friendly a country with Russia? I don't know exactly what you mean by that question, John, but I would imagine the Shanghai International Gold Exchange was created as a hub for global gold exchange rather than something for just China or just for, of course, Shanghai, big. It's got a great history of trading with the rest of the world, so it's a good place to put it. But it was created as a sort of alternative to the London bullion market or a rival to it. So the idea that the Chinese would be shutting down access to it for countries like Russia is, I think, it's much more alien than the idea of as happened here in the UK, where London, our sanctions started going directly after adversary states like Venezuela, and we ended up confiscating Venezuela's gold. I believe that was at the urging of Mike Pompeo. So I do think the Shanghai Gold Exchange would definitely stay open to Russia. It's whether or not Western financial institutions would prevent Western governments would prevent Western financial institutions from dealing with the Shanghai Gold Exchange. But even then, I think it's so removed. It's because you've got that one step removed from Shanghai. So it's not directly from Russia. I do feel like that would continue, unless, of course, it becomes a really, really, really big issue, the use of gold, which may well happen. Let's see. As John says, I meant Shanghai will make it easy for Russia to trade using its gold. Yeah, I would agree with that. Too. Very interesting to see Russia demanding European countries start charging rubles for their gas and put a load of buying pressure under the ruble, which I think is a very, very shrewd move. So you've got, as the classic Connolly saying went, the dollar is our currency, but it's your problem. There's kind of a ironic twist on this that Russia's delivered, where it's our currency and it's your problem. Where if you need to keep the lights on, you're going to have to stop. But you're trying to destroy our currency, but we're going to force you to buy this stuff in order to buy it. Oh, Melvin asked about CBDCs, central bank digital currencies. What will happen? Indeed. CBDC is very interesting. There are all sorts of dystopian futures you can imagine with CBDCs, where the government has direct access over your bank account and can summon or destroy any amount inside said bank account just at the flick of a switch. And at the same time, all of your purchasing power, your purchasing history is going direct through to the government. Now, in all likelihood, all of your purchases are already known by the boys at the donut in Cheltenham. However, CBDC, where it's really, really direct, I mean, it's an invitation for manipulation or to influence things or to monitor things, which goes a step beyond what we already have. And it's not formally admitted that the government knows everything you're buying, because they spy on the banks and they spy on the credit card companies. But when you say, CBDC, I mean, there it's out in the open. There's a classic tale from, I think it was 1970, where it was the Rand Corporation in America. During the Cold War, they're doing a wargaming sort of, get all these experts together and try and figure something out. What would be the best way of making a totalitarian system work without the constant threat of force? And effectively, what the idea that they came up with was what we experience today with using ATMs and credit cards, so electronic money that is monitored entirely by the state. And if you want to get money, then you need to go to a certain, they had their own acronym for it, what effectively is an ATM. So the state knows where you're withdrawing the money. So even if you're trying to avoid surveillance, they know where you're getting the money out to try and deduce that. And of course, whenever you pay for things with plastic, then the state knows where you bought it. And this was wargamed as the ideal surveillance state. And yet here it is, we've got it today. So CBDC, very, very grim potential for what happens with CBDCs. However, people fail in these grim dystopian visions of the future to remember it's government and it's public servants, and the market's generally a lot better at creating these things. So what's going on with the crypto space in general, uber fast payments through all manner of different and divergent technologies. We've been talking about CBDCs for many years, and what have we got? I mean, the Chinese have got their version of it, and it's getting a lot of pickup. But we've been hearing about CBDCs for a very long time, and we've yet to see them get rolled out in a big way. So the possibility of a dystopian future is definitely in that. But at the same time, you've got to recognize the incompetence of government programs that are summoned out of thin air in order to compete with private sector programs like the crypto space, and just how well they're gonna match up. So while Christine Lagarde has been very, very much out there saying we've got it, we need to create a digital euro. You got loads of lawmakers in the States saying we've got to get a digital dollar, and of course Rishi Sunak with Britcoin. Is that gonna arrive soon? I mean, we've been talking about it for years, many years now. Before I was even working at Southbank, before I was here, this was very, very big. Lots of ideas, and it was mostly contained within this narrative that interest rates are zero and they want to make them negative. How can you make them negative without people just pulling loads of cash out? And the suggestion for fixing this is, you just corral people into these, you corral people's money into these pens using central bank digital currency, where you're only allowed to transact using this thing, and then you start giving them negative interest rates in order to force them to blow their savings on things that they weren't going to buy otherwise, in order to stimulate aggregate demand, which of course is the holy grail, which must be achieved at all costs. So now interest rates are moving off that zero band, makes it maybe the force for that is less. Maybe it's much more about competing with cryptocurrencies, which are offering people a different, an alternative, a different future for what they do with their savings. It will be very interesting to see how Bitcoin behaves in a really strong inflationary environment, because we've not seen that before. But yeah, I think that would be my general views on CBDCs. Jason saying, be a Luddite, take back control, use cash. Yes, I would agree, Jason. You should definitely use cash. People need to keep using cash. If you're in Scotland, go to the bank and say, I want £100 notes. Keep those babies in circulation. Keep them out there, because the longer those things stay in circulation, the will be to phase out cash. And I call them the Scottish Bin Laden, because the €500 note was called a Bin Laden bill because it was used so much in money laundering stuff. So the closest you got in the UK is these £100 notes. You can get them in Northern Ireland as well. But yeah, keep using them. Or 50s if you're in England, because the more people use cash, the better. The longer we'll be able to stave off a dystopian CBDC future. Though at the same time, you do wonder, where people are so afraid of physical contact because of pandemics, whether or not that will be used as a narrative to smash cash. Because you're giving, it was people passing banknotes around that was spreading Wu flu like wildfire at the beginning of 2020. We've got to get rid of it. It's a public health risk. You can imagine that becoming popular. Melvin saying, you're wrong though, big data is up and running in Europe. I believe this is regarding transactions. I think so. Or maybe this is about, I would imagine it's about financial transactions though. Yeah, I mean, certainly there's plenty of financial surveillance that exists still in the Western world. But yeah, Graham asking, did they ever find the missing 50 billion in cash that went missing? I'm not familiar with this story, or if I am, it would be from a while ago, Graham. So I think I'd need to be more specific. But presumably, as I'm not familiar with the story, I'm guessing they either didn't or somebody did, but they kept it really, really quiet. I think that Melvin saying right. The digital ID connected to your CBDC is a very grim future. Yeah, social credit scores. Big data equals social credit. Yeah, social credit scores. One hopes that they're not going to come here. Because But given everyone's compliance with lockdowns and how popular they were in this country, I would not be surprised if they did get some kind of public support. If they do, I mean, I know I'm not going to be staying here in the UK for too much longer. No doubt, I would. I'd have poor social credit score for visiting so many pubs when I could have the flu or something. Though of course I don't have the flu, but even going to pubs was made a very, very bad thing during the pandemic, and all the great landlords in this country were very brutally treated, unfairly treated, I would say, by the government. So I did my bit. To keep them going. Yeah, New Zealand will not want your COVID-19 infected gold bars or obscure Celtic banknotes. Well, you know the rules, the golden rule, John. The golden rule is he who has the gold makes the rules. So, even if there's somebody who's afraid they're going to get COVID-19 still after all this, I mean, in New Zealand, are they not like quintuple jabbed or something? If you're still afraid of getting it, there's going to be someone else in New Zealand who will see a 1 kilo gold bar and be like, you know what? I'll risk it. I'll risk it. Well, as for Scottish banknotes, yeah, I would agree. Probably not. And Mario said, gee, sure loving the direction the world's headed. Me too, Mario. Isn't it great? A glorious, bright future. Robbie, my bank said customers are mad for 50-pound notes. I refused them. I only took 10s, 20s, and 5s. 50 is no good when paying for a loaf. Brat quote, no change, mate. That's true. Yeah, 50s are mostly good if you're either putting in an enormous round at a pub, or if you're at a casino. You'll see so many 50-pound notes at casinos. They're very good for those. They certainly won't object if you start pulling one of them out at a casino. 50 at the same time though, they are very cool notes. I mean, they're really cool. So you got to keep supporting the 50s where you can. I think we don't have a polymer 50 yet in the UK, but I don't think we do anyway. But perhaps I am wrong. But yeah, folks, I think we shall call it off here. Sorry, this is a slightly shorter than normal Southbank Live. Of course, Charlie did have to dash out. It's been very chaotic here as a result of, first we had issues with the stream last week, and we've got issues with the guest this week, but we shall be back again next week. It should be at our normal slot of 7 p.m. on the Thursday with John Butler next week. So we shall return there. That is all for this week. Thank you all for joining in. Sorry if I didn't manage to cover most of the questions, and it mostly was just me rambling at the end with some of the things you guys are interested in talking about. But yeah, we shall be back again next week. If you're watching a recording of this, I hope you enjoyed it, and do feel free to give us a like and a subscribe if you enjoy the content. Only if you enjoy the content, of course. If you do have any themes or questions you'd like asked in a future episode, do leave it in a comment below this video, as we do take a look at this to understand what it is that our viewers like and what they want to see more of. That's all from me for the moment, folks, so I shall see you in the next one. Bye-bye.